three precious metals bull markets that I've lived through, at some point in time, silver decouples from gold. Perhaps we've seen that in the last 4 weeks. And when that happens, for a time at least, the silver price seems to move twice as fast as the gold price. One would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line to speculate that the silver price could go up 600%.
Something extraordinary is unfolding in the precious metals world. A silent battle between real silver and paper silver that could rewrite the rules of global finance. Over the past few months, gold has hit new highs as central banks and investors race to hedge against a weakening dollar. But under the surface, silver's story is even wilder. Veteran investor Rick Rule says the silver market has become one of the most dangerously leveraged systems in the world. A market where 200 paper ounces trade for every one physical ounce that actually exists for delivery. That's not 200%. That's a 200 to 1 leverage ratio. He warns that this imbalance can't last forever. When investors finally demand delivery of real metal instead of cash settlements, the entire structure could come crashing down. And as we've seen recently, from global silver shortages to Indian ETFs halting new share creations, those warning signs are already flashing. So, what happens when the paper illusion meets physical reality? That's exactly what we'll break down today. Let's get back to the interview with Rick Rule and find out how this 200 times leverage could become the spark that ignites silver's biggest move yet.
But when we say that the silver market is distorted by paper silver, what does that mean? Break that down to us. How big is that distortion?
Let's not worry for a second about the exchange-traded derivatives. The ETFs, the Sprott physical products, because I think those are accounted for in the silver market. The claims that have always bothered me are the claims in the futures market. It is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. Now, virtually all of those claims, until very recently, cash settled, which is to say they weren't held for maturity. They were rolled over, whatever happened. Very recently, because of location disparities, which is to say the London market not having enough gold, there was a location premium for gold in London. And what that meant was futures holders in the US would actually take delivery of the physical silver and ship it to London to take advantage of as much as a 4% disparity in the London quote and the Chicago quote that was contemporaneous. A 1-day 4% premium. When that happened, the gold lease rates in the United States skyrocketed because rather than leasing gold, it was easy to make 2 or 3 or 4% simply shipping that gold to London. What has always scared me was an imbalance between supply and demand, between the physical gold and that paper gold, if more people stood for delivery. Make no mistake, Michelle, if you have a real imbalance in the futures market, you are not going to engineer the massive short squeeze that the silver people hope for. What the exchange will do is that they will halt silver trading. They will set an arbitrary price between buyers and sellers, and they will cash settle. That's what will happen. The exchanges run for the exchange members' benefit. That notwithstanding, that sort of market turmoil, what is likely to be the agreed upon cash settlement price, were that shortage to occur, I think would likely be dramatically higher in the circumstance that we see today than the price is today. And the dislocation in a market where 200 times the claims, where there are 200 times the claims relative to the amount available to settle on a daily basis, is a market that's really, really, really ripe for disruption.
When you say 200 times, you're saying is that like a 200 to 1 ratio?
Yes. Now, that doesn't happen every day, but there are days when if you look at the physical silver available uh, in North American futures markets on the COMEX as an example, good delivery silver in system available for the settlement of the claims, it is not unheard of to have 200 times that amount of silver traded in contracts on a daily basis. Now, the huge majority of those things cash settle. They aren't
Hmm.
presented for delivery. But in a situation where you have these goofy location swaps, 4% difference in spot price between London and Chicago, it's very tempting to take delivery, ship it, and grab the money. So all of a sudden, you had a situation where uh, the held for delivery proportion of those trades relative to the cash settlement portion of those trades went up, and the COMEX got stressed. I'm sure that your channel's employer, has also seen a remarkable shortage of small denomination physical silver products, the 1 ounce products, the 10 ounce products. We've noticed at Sprott that there is no shortage of silver available to us in good delivery in wholesale quantities. In other words, the bullion banks have been able to supply Sprott with the physical silver that they need. But the dealers have had a very difficult time keeping retail denominations in stock. They've also had a very difficult time hedging their silver inventories and leasing silver inventories to make available inventory to their clients on a short-term basis. There's been a dramatic turmoil in the silver market. Your own sponsor being one of the few that seems to have been able to stick handle their way through this crisis in good order and service their clients.
How does this ratio of 200 to 1 in the precious metals market, and I guess silver in particular, how does that compare to other assets?
I've never understood it, first of all. The idea that the price of a substance should be dependent on its relative abundance or scarcity in the Earth's surface doesn't make any sense to me. It's a good way to generate commissions or sell newsletters, but that ratio doesn't go to utility. It doesn't go to production cost. It doesn't go to stock versus float. The idea that silver should be, or that gold should be 16 times more valuable than silver because silver is 16 times more abundant in the Earth's surface doesn't explain much to me. People pay a lot of attention to it, and I think it's actually become a factoid. I think that when people quote that number, they actually impact the market's perception and the market's action. I'm just not sure why the statistic is valuable.
Rick Rule has spent decades studying commodity markets, and his message now is crystal clear. Silver's pricing system is built on a foundation of leverage, not supply and demand. Every trading day, the volume of silver futures on COMEX and the London bullion market can exceed the amount of deliverable silver by as much as 200 times. That means hundreds of contracts are competing for the same limited pool of metal, and most of them are never settled in physical form. They just roll forward month after month, creating the illusion of liquidity while masking deep structural fragility. According to Rule, this system works only as long as nobody calls the bluff. But when physical premiums appear, for example, a 4% higher silver price in London compared to Chicago, traders rush to take delivery and exploit the arbitrage. Each time that happens, metal leaves the vaults, the paper-to-metal ratio tightens, and stress builds across the exchanges. We've already seen this tension manifest in 2025. Silver spiked above $50 an ounce as inventories plunged, lease rates surged, and global mints struggled to meet retail demand. Some Indian and European ETF providers even froze new unit creation because they couldn't source enough physical silver. Meanwhile, gold hit record highs above $4,000, signaling the broader flight from fiat currencies. Yet silver, the smaller market, reacted with far greater volatility. Rule explains that if gold climbs 300% during this bull run, a scenario he finds plausible given central bank buying and de-dollarization, silver could climb 600%. He bases that not on speculation, but on every precious metal bull market he's witnessed. Silver eventually decouples from gold, moves roughly twice as fast, and captures late-cycle investors chasing bigger returns. But he also warns that investors shouldn't confuse short-term manipulation with long-term suppression. All markets, from LIBOR to treasuries, are managed in the near term. Silver's difference is scale. With so many paper claims on so little metal, concentrated trades can move prices temporarily. Yet when physical demand overwhelms paper control, price suppression collapses violently. That's why Rule insists true